Hello friends, welcome to another episode of InsurTechLA. My name is Gilad Shai, and this week I have the pleasure to host a conversation with Emilio Figueroa. Emilio is a property and casualty industry veteran of nearly 3 decades. He created multiple insurance programs across various verticals. His experience in company formation, policy creation, actuarial analysis, and carrier and reinsurance contract negotiations. Today, Emilio is the Chief Insurance Officer for Foresight Insurance, a smarter workers' comp MGU. Please, join my conversation with Emilio. So, thank you very much for joining me today. It's great to see you. It's great to see that you actually dressed up for this occasion. I truly appreciate it. You are the professional.
I am in the office, just came in here for you.
Yeah, I appreciate that background. Now, for people who don't know you, can you please give a quick introduction and tell hey, this is my insurance journey?
Sure, happy to do so. Hi, everyone. So I've been in the insurance industry for about 30 years. Done everything on the commercial line side of the space. Anything from having a large brokerage here in San Diego, being licensed in 16 different states, writing a lot of business within those states, and focusing mainly on the commercial space, but within that, the construction verticals, manufacturing, industrial verticals, etc. Also had a large MGA based out of California as well. Had a premium finance company that was based out of Utah. I've had everything on the alternative risk transfer side, from a risk retention group to an 831B captive to a segregated cell captive to a standalone captive, domiciled out of DC. And then I had 2 reinsurance companies in Bermuda. So everything on the insurance chain, every one of the little links that is attached to the insurance chain, which would be the brokerage, the MGA, the financing, the captive, or like a baby insurance company, and then the reinsurance.
Thank you. And that's great. And nowadays you are the Chief Insurance Officer for Foresight. What is Foresight?
So Foresight, we are a true InsurTech. In my eyes, an InsurTech is having a foundational technology that's standalone, and then creating an insurance program around that foundational technology. So for us, we have a risk management platform that's been around for about 6 years, thousands of clients using the risk management technology, and we created an insurance program around that technology. So initially, we're selling commercial workers' comp. We are licensed in 8 states right now. Mm-hmm. And we're looking at bringing additional lines of business to that program, to enhance the program and expand our national capacity eventually. So we'll be adding general liability, commercial auto, property, excess, etc.
Now, we know each other for, I would say, maybe 4 years, maybe even 5 years now. And I was lucky enough to see you in the different roles and different, I would say, dimensions throughout the industry and throughout time. And what I would really like to use this opportunity and take this conversation more into the professional side, because we usually lack that part of the understanding, the deep understanding of the insurance industry. And if you don't mind, we're going to take it that direction.
Okay.
Oh, and listen, we can start by what is the decision, especially now that you are the Chief Insurance Officer, what makes the decision to move to the next step? To the next state, to get the license and start operating there?
So for us, we'll look at the demographics within the state. We'll look at the size of the business within that state per industry vertical. Mm-hmm. For example, construction. So right now we're writing California, Nevada, Arizona, New Mexico, Texas, Louisiana, Oklahoma, and Arkansas. So let's say we want to go into Florida. So we look at the landscape in Florida. In Florida, the workers' comp landscape is very, very aggressive. There's a lot of PEOs writing business in Florida. There's the regulatory concerns with the legislation in Florida would I would say personally, I wouldn't want to go into Florida and write business in Florida, but I might go to the surrounding states. We might go into Georgia instead, or Atlanta, or wherever.
Now that's a great point. And we know that Jersey, New York, and Florida are notorious for their, I would say, regulation and doing business there. Why? Can you elaborate a little bit? Why not Florida?
For me, for work,
that Florida presents.
Well, I mean, for workers' comp, I wouldn't want to write too much business in Florida. There's money to be made in Florida. There's a lot of money. There's a lot of businesses in Florida, and it can be very successful. But there's so much competition from the PEO space, the preferred employee organizations, that are coming in very aggressive. They're writing anything based on price. And for us, we are first and foremost, obviously, an InsurTech, but we are underwriting every account very diligently. If we're not, our minimum premium for our program is $25,000. So we're looking for larger accounts. Actually, we're looking for $250,000 accounts. So for us, it's more middle market. So we can go in there, but we would have to tread very careful to see the previous history of an insured, look at their operations in detail, do a loss control, aggressive loss control, so we can make sure that we can help them mitigate any future losses they may have, and have an insured be very proactive. A lot of the times when companies are with PEOs,
mm-hmm.
they're with PEOs because it's price driven. They don't have a big risk mitigating culture within the organization. And for us to change someone's methodology is very tough if they don't care about it.
Foresight, is that an MGA? What is the current status of it?
So Foresight, we're an MGU.
MGU. Okay. Can you give a quick glossary of the definition of MGU?
Yeah, so an MGU is the managing general underwriter. An MGA is the managing general agent. The agent usually is a distribution platform only, and they don't have underwriting authority. We have underwriting authority within our organization, and then we also handle claims. We deal with our TPA. We pretty much do everything a carrier does without having the paper.
So, okay, you almost answered that already. So what's the difference between an MGU and a carrier?
Having paper.
Having the paper.
Having your own insurance company, your own shell, having the certificate of authority from the different admitted or non-admitted states that you want to be in, and having the financial wherewithal to have large reserves. So let's say if we had 150 million, 200 million in reserves, then we could start looking at getting a paper, or creating our own paper, or getting our own licensure, so we could be an insurance company.
So if you don't mind, if we are already doing this Insurance 101, so you're an MGU, there is the carrier that you need the paper, the shell, all that stuff. And most of the insurtech companies that we saw at the beginning, they were agencies. Now we see more and more people who claim to, companies that claim to be an MGA, but at the end of the day, they are a program administrator. What is a program administrator, and what are other, let's call it, more authorities that we have in space? So
a lot of the insurtechs that you see, that call themselves insurtechs, it's a little technology wrapped around a program administrator, we're going to call them. So they're an MGA/program administrator. So program is just what it is. So you have a book of business, a specific industry, or it could be all industries, or it could be based on premium levels. So we can say someone that sells workers' comp direct to the consumer. Premiums are in the 5,000 range, under 25,000. That's a program administrator if they don't underwrite internally. Let's say they're quoting online, but all that data that's being input online is being transferred directly to the carrier's underwriting methodology or matrix or ML underwriting platform, and then it spits out a pricing. Through that, they're just administering the program. They're not actually underwriting it internally. And for them, they're more of a distribution arm for the carrier.
Mm-hmm. So when do you want to move to the next level, or to have that underwriting authority or the binding authority, or to have the paper? When do you want to move between those levels?
Well, it just depends on your distribution. It depends how much premium you're writing. It depends how much control you want to have in your book of business, and it depends on whoever's paper you have, whoever you're working with. You know, if they're investing in your company, you might not be able to go anywhere else. You might be stuck with them, or if they created you, you might be stuck with there. It just depends how, you know, how the structure of the company is set up, and what the long-term goals are. If you want to be a program administrator and then go to an MGA, and then go from an MGA to an MGU, and then if you want to go full stack and have your own insurance company, there's many different ways to do that. But if you start as a program administrator, usually do that just so you can build a book of business. And then once you have a large book, then you can start looking for different papers.
Gotcha. And you guys are already at the point of being an MGU. So what will be your cost to move to the next level and become a carrier?
So we would maintain the MGU as a distribution platform, and we would purchase a shell company, a shell insurance company. It's a company that's sitting around, not writing any business, owned by, you know, a large conglomerate of insurance company, someone like AAG. They own hundreds of different shells, for example. We could buy a shell from them and then start writing business under that shell, as long as we have the necessary reserves and the correct reinsurance partners to help us.
So a shell, we know that in terms of, if you create one from scratch, it's about 100,000 just in legal fees, and then 80 to 100 in terms of the licensing. And it's about 8 to 12 months while you're waiting for everything to be approved. If you acquire one, how long does it take? Does it save a year in waiting?
Absolutely. So if you create your own insurance company, it'll take about, you know, roughly 9 to 12 months, most likely under 12 months. And that's if you have, you know, you're going to have one domicile. Once you get that domicile, then you can get the letter of authority from the other departments of insurance and start writing in the respective states as you grow. Or you can buy a shell that is licensed in 5 states, for example, and you purchase it. It'll take you roughly about 4 months to close the transaction, get the funding, and get approval from the regulators on the purchase or on the sale and purchase, and then you could be writing business within 6 months in 5 states versus getting it, you know, in 1 state, going from scratch, and then doing it that way.
Yeah. No, that's very interesting. And now, do you have any example or something that you can share from your past?
In regards to shells or in regards to captives, what would you like to talk about?
Oh, we can talk about captives. Why not, man? It's your experience. I've been just shooting questions that are sort of like, hey, let me go through this list of questions, but you know, you can freestyle it.
Perfect. Let's do it. So, you know, as we stated, you have the broker. So there's a chain. There's a chain within the insurance ecosystem, and each chain has a link, right? So within insurance, you have 5 links. You have the broker, you have the MGA, MGU, you have premium financing, you have a carrier, and then you have reinsurance. So those are the 5 links to the insurance chain. Within that, instead of having an insurance company, you can have what's called a captive insurance company, which is a baby insurance company. So it's not, you know, a gigantic company. You still need a carrier to use their financials and use them as a front. So you use their fronting paper, but it's still your book of business and your captive insurance company. And you could pay someone like State National, you know, 5%, 6% to use their paper. There's a lot of companies out there that you can pay them to use their paper, but then you can, and that's all you do is pay them for usage of the paper, and then you could write everything under your own captive.
Now, is that for commercial, personal lines, or life? Will it be the same percentage?
It depends on the front. Some fronts are lower, some fronts are higher. There's a lot of fronts out there. Your average is about 5 to 6 points to use them as a fronting paper. If you have, you know, long-standing relationship with an insurance company, you can bring that down to 4, 3 points, which is great. But historically, you know, it ranges from 3 to 5, but 5 is pretty standard right now.
Mm-hmm. And how does it relate to capacity? So, yeah, sorry. How does it relate to capacity?
So in regards to capacity, if you're an MGA, you have capacity that's assigned by the carrier to you. So let's say they tell you you have, you know, 20 million, 30 million in capacity for the year. So that's how much business you can put into the program. let's say you're an MGU, you have a little more latitude. Let's say you can put 40 to 50 million into the program. Your carrier partner has a little more faith in you. Your reinsurance partners have a little more faith in you, so they believe in what you're doing. They see the benefit. Let's say you're a captive, and you want to take a quota share. So you want to take, let's say, a 50% quota share. You're going to take 50% of the risk within your captive, and then you're going to cede the balance off to a reinsurer in order to be able to take, or multiple reinsurers. In order to be able to take a 50% quota share, you have to have the financial wherewithal to be able to do that. So you need to have reserves under your captive that are going to be looked at by your captive domicile regulators. So when I had a captive, I had it in DC. I love DC as a captive domicile. You can have captives all over the world. You can be in Malta, you can be in Hawaii, you can be in Bermuda, you can be in the Caymans, or you can be domestic. You can be most states in the U.S. have captive domiciles. Delaware is pretty much where most of the captives go to. But then, there's many different states that you can do it in.
Yeah, Delaware. We all know Delaware from a different direction, especially from corporate law. I think that's mandatory in all of the MBAs. But you talked about the magic, not magic, but the best known secret, the Cayman and the Bermuda. What's so special about them?
Well, before the current taxation changes that have happened, a lot of companies would use offshore captives as tax havens in a way. So you could send your money offshore. If you don't bring it back into the United States or repatriate the funds back, then they're tax-free if you use them offshore. You can't use those offshore funds while you're within the U.S. But if you keep them offshore, then you could use them wherever tax-free, as long as the regulators in the offshore domiciles let you or release those funds to you. But there's a lot of taxation reasons why people were doing, Bermuda, the Caymans, etc.
Mm-hmm. No, that's good. So people who would like to get a little bit more knowledge, they should reach out to you and get a little bit of more insights to that.
We'd love to chat over beer or coffee.
I would love to do that as well. I've been a little bit more on the safe side of COVID, or as I call, I will meet you guys face to face about, September 2021.
No, I think we can do it via Zoom. We'll do coffee or beer via Zoom.
Yeah, coffee we can, most definitely. During the day, somewhere outdoors, no problem, including the beer. But especially because you're also in Southern California, and that makes life easier. We talked about tax, we talked about other stuff. Now, you back in the day, you had a reinsurer in Bermuda. Can you share a little bit about that operation and your experience? And if you have any anecdotes from that?
So I had two reinsurance companies in Bermuda. Eventually, I combined them into one and re-domiciled them into the Caymans. But the main reason to have that, and the reason that I had two, and not, why have two instead of just having one? Well, one, I had a partner in one of the cells, or one of the reinsurance companies, and then I had a standalone that was mine. So I had a 60% quota share ownership in one of them, and then a 40% partner. And the other one, I had 100%. And that's just to expand on, what risk levels we were willing to take on the respective programs that we were writing. So if we have, under our captive, we had a segregated cell within the captive, and we were doing liability. And then we had another segregated cell within the captive, and we were doing workers' comp in that. And it could be, homogeneous, it can be whatever. And the different segregated cells are standalone. They segregate liabilities and assets within the cell. So there's no crossing. So let's say on the liability program, I wanted to take a 20% quota share, but on the workers' comp program, I wanted to take a 60% quota share. But if my partner didn't want to take it on the workers' comp, I could take it alone from my respective reinsurance company. And that's why I set up multiples.
How is the relationship between the reinsurer to the carrier or reinsurer to the MGU?
Okay, so reinsurers, usually when you have a program that you're building and you find your carrier partner, once the carrier partner decides to write the business with you and starts looking at launching the program, then you look at getting your reinsurance panel, your reinsurance partners. The agreement will be between the reinsurers and the carrier, but the reinsurers will have to vet your program. So you'll have a close relationship with the reinsurers as well, because they're looking at your program, they're looking at the type of business you're writing, they're looking at your underwriting guidelines, your underwriting methodology, what type of people, and their background are running the program. Because ultimately, even though the carrier is responsible, they want to make sure that whoever is running the program has the experience. They have the underwriting methodologies down. They have the same goals as a carrier partner. So it's a lot of, and what I see with a lot of InsurTechs is that they don't have a lot of people with insurance experience. And in order for them to be successful, they need to start bringing in people with a lot of insurance experience internally. They might go out and get a good underwriter after they want to push a program, but by then it's too late. You need to have people up front with the knowledge of with the knowledge and with the same path as to what you want to do in the future and how you want. But they definitely need someone when you have an idea, make sure that your idea first works if you have a technology, and it's any company that's in the C level, they need to make sure that their idea has traction. And then if you want to bring it into insurance, you need to bring people in that have either the experience to build a program or the underwriting methodologies. But you definitely need people within the insurance ecosystem to bring into your team.
So if a startup that listens to us say, okay, I get it, we need to bring one, where do they find the person that can bring that knowledge and skills?
That's a tough part. Start going
to
insurance conventions. A lot of the people in insurance conventions, they love the technology. They're looking at people that may be interested. Start looking at advisors. Bring in a mentor that has insurance experience. There's a lot of people out there that are retiring that would love to mentor companies, would love to be a part of the new wave of insurance. And they would be excited. They're bored. I mean, especially now during this. I mean, they need to do something and at least work remotely, and be happy and mentor someone. They're more than excited to do something.
Back a little bit to Foresight. Now, recently you received a little bit of professional love from Willis Tower Watson. Can you tell us a little bit more about it?
Yeah, absolutely. So Andrew Johnson from Willis Towers Watson does a quarterly InsurTech briefing. And we're part of the third quarter briefing for this year, which describes the new, hot, and upcoming InsurTechs or companies to watch. So we were one of a group of very interesting InsurTechs that are coming out with what specifically with what we're doing. With Foresight, we have a risk management technology, and our risk management technology, we've wrapped an insurance program around it. And for us, it's to change and mitigate company cultures. So by using somewhat behavioral economics, by nudging someone to log their observations or their risk mitigation strategies through our application, we can change their behavior and minimize their risk, making them proactive within the company ecosystem. So for us, minimizing claims. How do we do that? Well, we engage the frontline worker and everyone within the organization, and we have them do observations. We have them do hazards, and everything's done through the application. They do inspections, they do tailgate meetings, they do their OSHA reporting there. So they're doing everything digitally. And we see the engagement of the individual employee. We can see the engagement of a respective job site. We can see the engagement, on a geographic level or on a holistic level across the company culture. And we grade them. We give them we give them a risk score on a granular level, but also on a higher up level. So we're looking at, let's say, XYZ company, and they have a risk score of B. But then if you go on a granular level and you look at all their employees, their risk scores fluctuate. And we can see why they're fluctuating based on the engagement type, the engagement location, etc. And by helping a company do this, and by helping change their engagement levels and their proactivity to risk mitigation, then we can show that we can reduce the frequency of claims by up to 57%.
No. Wow,
Just
impressive. That's very impressive. 57%.
well, we had an actuarial study done by per night, and there was a large job site that didn't have, it was a 2 to 3 million man hour job site. They didn't have the technology. They built one building. They didn't have the technology when they did that. They incorporated the technology before they built a second building, and it was 2 to 3 million man hours, like I stated. And after on the second building, they noticed that the frequency, just by engagement, the frequency of claims was reduced by 57%. So we're not saying everyone's going to be 57%, but we could say someone can be 10%, 20%. If we change and move that needle 1%, and we could save one life or one injury, it's worth the usage and it's worth what we're doing.
And here is a question that I ask everyone. Can you give a recommendation of a book or something that we need to binge?
A book or something that we need to binge?
Yeah.
There's a lot of books that I love reading. Misbehaving by Malcolm Gladwell. Love the book. Highly recommend it. Something I binge on is I have all my reinsurance and insurance industry.
People actually read that? What was that? Was that best review?
So the first one was best review.
Okay.
So for me, I am an insurance nerd at heart, so I'll be reading that. The next one is business insurance, obviously. Multiple business insurance, but I love reading best review. You know, there's Insurance Insider. There's so many different publications out there, and just being, you know, you're in the industry and you're interested in seeing what's happening on a global level and seeing what's happening, you know, national but global level. It'll give you a better pulse or a better beat on the pulse of, you know, what's happening within the industry, and who the players are and who's coming in and what, you know, what the competition's doing. So you need to get involved. Yeah.
That can be an interesting episode by itself, just to explore the information flow that we get and how the different outlets, the media outlets that we have in insurance, what is the type of data and information digest they provide. We know these guys, we know the Coverage Air, Insurtech, there are all kinds of different folks that gather the information. And of course, you have the newsletter that almost come out from the regulators and the NAIC. It's very, very, very interesting. I like that. But we can
we can definitely have a 45-minute hour show on just what everyone's doing, because not everyone just can grab all the information that's going on. But you know, companies like Coverage Air and companies like, you know, business insurance, they do a good job of aggregating that information. But I don't think there's one service that provides enough, and I think that's for the best. I mean, it's better when you have multiple sources, and if you can look at 2 or 3 sources, I think that's key. It gives you a good holistic approach to it.
You shouldn't have one, because then there is no positioning, and then marketers will not have work, right? You need to have a better positioning of the product and what they are actually providing, and from there you can have multiple angles and perspectives to a problem or not a problem. In this case, it's going to be information and how it's being digested. The same thing that, well, it's always good to see CNN and Fox in the same time, because you can really see which one editing it to a different direction. But again, nowadays we don't see news, we just get opinions. We may or may not cut this out.
We should probably cut it out.
But listen, it helps me because my positioning in here is just having conversation with all kinds of interesting people in our industry. If there are subject matter experts or anything else that, you know, have that knowledge about what the hell is going on, yeah, I'll cut this out as well. But at the end of the day, it's super interesting, right?
I mean, we could talk for hours, and it just, you know, the industry is very, very interesting. There's a lot going on, and there's a lot of players. And there's a lot of players that I'm surprised are still going on. And someone like Lemonade, it's like, really, come on, man.
Lemonade, they are sort of the Qatar. They are the engine that moves the InsurTech,
yes.
Right? We just touched, well, they are amazing and what they are doing. But I'm more interested about all the others. We heard enough about Lemonade, Hippo, Next.
Yes.
It's more interesting to see how the other folks are working that and what makes them move forward. It's, for example, Foresight. You guys, start. When did you guys start?
We started writing, Foresight was created 2 years ago. We were in stealth mode. We launched our workers' comp offering late July, and we started doing press announcements, I would say, in August, September.
And this is where it's interesting that, this type of story is interesting. Also, you see with the relationships to the legal, the lawyers who are entering that space as the support. You mentioned Per Knight as consultants that supported. What are the different changes that they had? Of course, the carriers, the reinsurers. What does it mean now if you have a captive? How does it changes the way that you approach? And recently, I think that you made an introduction to me from, I would say, an old school MGA that reached out and wanted to learn how to become an InsurTech.
Yes.
That's another very, very interesting story to tell about, yes, they've been running business in Southern California for 20, 30 years, and they say, oh my God, there is all this amazing technology that we can utilize, improve our operation, and actually grow into new segments and new classes of business. Yeah, it's pretty good, man. It's very cool time, although we are not meeting face to face.
We are now, somewhat. Digitally face to face. Yeah, no, and it's good. I mean, and it's good seeing legacy companies, changing their methodologies and seeing how, if they don't start being more flexible, then they're going to disappear. They need to start looking at, and not necessarily being an InsurTech, but using InsurTechs that are out there, whether they're vendor providers. There's a lot of interesting companies out there that are providing a lot of amazing technology. Some of the data partners out there, we have multiple data partners, and they're amazing. The amount of data that can be pulled and brought together into changing underwriting alone is impressive. I mean, right now, legacy-wise, you get a submission, that's your court form, your loss history, and a supplemental application. You look at that, and it's usually regurgitated information.
Okay, so tell me more about that, because data is super important. What can you use and what you can't use for underwriting?
So, I mean, you can use pretty much anything that's out there. Data is data, but you want to use clean data. So, for example, what we're doing is we're getting our submission from our brokers, and as we build our digital portal, we're getting it uploaded into our platform right now. So we're grabbing that information, and just by looking at the name of the business, the address, and their tax ID number, we're going out and getting over 300 data points. So, and we're talking everything from, let's say it's a construction firm. We can get permits. We're pulling permits for that contractor that contractor has filed in the respective city that he's in, and expanding it outward. So you go from one city to the next city, and we go state level. We can go multi-state levels. And looking at the filed permits going back to 24 months, for example. And then you can see what they filed 24 months ago or 3 years ago, and you can see what they filed the past 6 months on a granular level. The job type, the job cost. So this is a general contractor and he's doing everything, perfect. But if, let's say, it's a plumber who filed an electrical permit, then that causes a flag for underwriting. Right now, carriers don't get that information, and the ones that do, if they get that, it's very tough to grab that information. If you don't go, normally you have to go to the city and get that information. To do it digitally is very, very tough. And there's underwriters that will go to the city and pull that information just out of curiosity, but we'll pull all that information. Our underwriters have so many data points, and then we grab the data points that we have, we compare them to the application and see if there's any flags that are going to be pulled from that. We're pulling NCCI data, we're pulling WCIRB data. There's so many data points out there that you can get. And then on top of that, we're correlating it once they become insured. We're correlating the data points that we pulled for underwriting, and we're looking at the data points that we're grabbing from their engagement in our technology, and we're correlating it for the risk score. We're correlating it for underwriting, for future underwriting. So there's a lot you can do with that. It's pretty amazing what, the amount of things that are out there in the world.
And I love that because that's finally getting into the, let's call it the secret sauce of insurance, the data that you get and what is actually relevant for what you're doing. And as you improve on it, you'll know it only when you'll get the first claim. And the other one will be, of course, that's the limitation, right? If you don't have access to data, or if you're just a program administrator or an agency, you can write whatever the underwriter is set for you. So if it's an old paper by a large, and let's call it sort of a legacy carrier, you are limited, but the data points that they are collecting for you, sorry, that you collect for them.
Correct.
And for you as an MGU, you have the liberty or the freedom to go ahead and set, okay, we need 300 different points, but actually we need 1 point. And based on that, we're going to automate the collection of the other 299 data points. Now, I love that.
Right. I mean, and normally within, on the commercial insurance side, at the very least, you're collecting on average between 25 and 40 data points from the submission that you're getting. And then, the underwriters will go out and they'll search for, in different places, but they might get another 40, 50 data points. So they might get 80. We're getting close to 4 times what the average underwriter gets. So a 400% increase in data points is dramatic.
So now, of course, we need to ask, where is the regulator? Where do they limit you?
So the data points that we're using are just standard public data points, or some private companies that we're pulling data with. We're creating different scrapers within that to be able to pull data points for pulling permits or different things. The regulators start limiting you when you start looking at individual data, an individual's data, not a corporation's data, but a human. It's usually, they'll look at your credit score and making sure that whatever data you're pulling on everyone, you're using it across the board without discrimination or without any discriminatory concerns that they may have. If you're going to pull credit scores, okay, and then you're going to base, your tiering based on a credit score, that's fine if you're going to do that, but then you can't do it based on geographic locations and the credit score. So you have to be very careful with what you do. Your overall rating has to be on the type of business and the risk threshold that you're willing to take on that business.
No, that's great. That's a great tip. And always remember to consult with your legal team. Emilio, thank you very, very much for joining me today. It's been a pleasure. And always, you are a source of so much knowledge and experience.
Gilad, thank you. It was my pleasure to be here. Love what you're doing. Keep up the good work, my friend.
Thank you.